Let's welcome in our first guest on the show. Sanjeev Prasad of Kotak is now with us. Sanjeev, you always, focus on valuations, and, valuations need to be cheap before one enters in, whether it's a sector, whether it's a market. How would you look at this argument that Indian market is expensive for the last 1 year? Do you think there is a structural shift in valuations, at least for now, from investors?
Well, I don't know whether necessarily I look at cheap valuations to be cheap. Valuations have to be reasonable here, in the context of growth and the quality of the company. Anyway, coming back to your question on valuations. Okay, valuations are expensive in India. Yeah, they have been expensive for the last year or so, I would say. But also keep in mind the fact the market has not really given any returns in the last year. It's been pretty much flat now on a year-on-year basis. I think the market would be just about flat to maybe 1 or 2% higher. So in that context, high valuations as a starting point definitely act as a drive on the market. Currently, I guess we're in a similar situation. If you look at the market on a 12-month forward basis, I'm talking about Nifty 50 index, it's somewhere about 20.5 times, which is not a cheap valuation by any stretch of imagination. More important, if you look at all the quality growth stocks, whether they are in the consumption space or in the investment space or financing consumption, most of them are looking, pretty expensive. In fact, most of the consumption names are trading at far higher valuation compared to where they were on a pre-COVID basis. Since then, I would assume interest rates have gone up clearly, and India's macro position has deteriorated. Against that, I guess investors are assuming India's growth rate will be higher in the long term, which is fair. We are believers in India's story. But, to justify these kind of valuations, it's a struggle, to be honest with you. If we do any sort of a reverse valuation exercise on the companies, the implied volume, profitability, prices are, looking fairly scary for many stocks. So that's the big challenge now.
Hi Sanjeev, this is Anisha also joining into the conversation, and perhaps the valuation scare is something that really explains your recent portfolio recommended changes, wherein you have removed Ashok Leyland and Oberoi Realty from your recommended mid-cap portfolio, given the fact we have seen quite a bit of run-up over the last 12 months. You've added Sun Pharma and removed Motherson Sumi on account of the high exposure when it comes to the European geography. But very interesting note, Sanjeev, wherein you talk about decoupling is not possible in reality, though at least this is something that we have seen has played out over the last 7 to 8 months, wherein the Indian markets have definitely outperformed what's happening across the globe. Why do you think that decoupling is not really possible for India?
Well, India has far too many interlinkages with the global economy. It's not as if India is a big continent by itself. It's a very large economy and all that stuff. Yes, it's a big country, but from an economic standpoint, it is ultimately linked to the world. We have a lot of exports and imports. If you look at, we have a lot of energy linkages. So if there is anything going wrong in the world, our economy will also have a corresponding impact. Look at a simple case of recession globally. If that's the base case, then I think India will also struggle because our exports will really see a slowdown. Anyway, we are not seeing too much of growth as far as exports are concerned. If you look at export data for the last 2 years, last 15 months, they have been pretty stagnant at about $25, $26 billion if you look at the non-oil exports part. And on the other side, if you look at imports, unfortunately, given the global energy situation, our imports have gone up significantly, and who knows, if winter is not going to scale, what happens. So all said and done, it's simply not possible for any economy now, essentially a very small economy, linkages with the world. You simply cannot have, this decoupling. Maybe the markets can decouple for a few months, because of whatever reasons, people start believing some story, about a particular market. So you can have this, periods of outperformance of the market compared to others and so on and so forth. But otherwise, economic linkages are way too high, these days to assume that, India will probably do well despite whatever is happening in the world. We have risk of sentiment globally. It's not as if, India will, do very well in that kind of an environment. Same way if you have a global recession, India's economic growth will also come up.
Okay, interesting. So maybe in the near term, we can see some sort of decoupling, but that's not really possible on a sustainable basis. That's the word coming in from Sanjeev, given the very strong economic linkages across the globe. But Sanjeev, of course, the one biggest talking point across the global economy is the fact that dollar index has been on a rally of its own. It's now past the 110 mark at a 20-year high. How does an Indian investor really play the themes with respect to this dollar index going higher? Is it the right time then to look inwards to your domestic sectors, the likes of industrials and financials? How should one play this entire theme?
This rise in DXY is more to do with, the fact that the US Fed is ahead of the, compared to other central banks. I'm talking about developed market central banks in terms of raising rates. Also, US dollar is a reserve currency. So if you have a lot of uncertainty globally, there will always be a rush for the dollar, and you will see accordingly strength over there. And lastly, you have a lot of challenges in the other big currency block, which is the Eurozone, given all the worries about slowdown or more like a recession, given the energy challenges the economy is facing, given the ongoing conflict between Russia and Ukraine. So all put together, that is what is leading to a big increase in the US dollar against all other currencies. How long that will continue, we'll have to wait and see. But look, other central banks will also start raising rates sooner than later. The ECB has no option but to raise rates given where inflation is. So as the real interest rates, start aligning globally, I would assume dollar appreciation, which has been the norm over the last few months, that will probably not be the case. I mean, keep in mind the fact that US ultimately, from a fundamental financial standpoint, is not in a very strong position. It runs very large, fiscal deficit, always have had very high, trade/current account deficit. So it's not as if dollar can strengthen in perpetuity. At some point in time, dollar will start weakening. Whether it happens over the next 3 or 6 months, only time will tell. But I would assume it will start reversing as and when other central banks also start aligning their real interest rates more closer to reality, in the sense you can't have such high negative real interest rates forever. And sooner or later, all the central banks will raise rates to counter inflation, which will result in more neutral, I would say, real interest rates across the world. In which case, the relative strength of the dollar will probably give way.
Right. Can you just talk about banks particularly? For last 3-4 years, it's been one of the consensus buy calls which people have. However, it's just been a market performer or at best a underperformer, X1 ICICI or some of the other few banks. Do you think banks are in a sweet spot considering the Q1 numbers? After Q1 numbers, everybody upgraded banking names?
Looks like it's one of the spaces, at least the valuations are more reasonable compared to the rest of the market. And second point here would be that at least we don't see much of a credit cycle, at least for the next 2-3 years. In a sense, we are past the last credit cycle. Corporate NPL cycle got over sometime in FY20. Since then, corporate India has been doing quite well. And whatever challenges were there in the COVID time frame, with respect to the retail and MSME loan books of the banks, even that has been more or less addressed now with ongoing economic recovery. So I don't see any sort of a credit cycle over the next 2-3 years at least. And hopefully we'll see credit growth coming back. There could be some challenges on NIM, given the fact that deposit growth rate has been not very strong. But other than that, I don't see any real issues as far as the banking sector is concerned, and valuations are quite reasonable. I mean, if you ignore some of the high price to book NBFCs like Bajaj, Chola, etc., almost all banks and NBFCs are actually pretty reasonably valued.
Okay, so we of course have been told also by a bunch of brokerage firms that we should brace ourselves for a second re-rating when it comes to financials. And Sanjeev, Prasad, we've been talking whether it's going to be the year of banks and financials and if they're going to end the year on top. I know you've addressed the first part of our question. The second part I want to ask you is, and for what our viewers will want to see, the large banks, there are some that believe are their valuations too high. ICICI is often spoken about as perfection. Would you expect a lot of the action, therefore, to be with the mid-tier banks, something that we've been seeing in the stock markets as well?
It all depends, how the macro environment pans out. If you have some sort of a risk on sentiment, then I assume that tier two, tier three banks and NBFCs will do probably better. Then people will be willing to, take a slightly more, aggressive call in the market. And in that context, the tier two, tier three banks should do better. I mean, most of them are, pretty reasonably valued. If you look at the smaller PSU banks or the NBFCs, most of them are trading at about one time plus minus 1 year forward book. So in that context, re-rating is very possible, very much possible, given the favorable tailwinds that I highlighted. But if you see some sort of a risk of sentiment coming back, let's say linked to worsening of the geopolitical situation, energy prices, spiking in winter, then you will have some challenges as far as the smaller banks are concerned, because these are traditionally, very high beta names. Little bit of, shake up in investment phase, and you will see a correction in movements. I mean, despite the fact they are still trading at very, very cheap valuations. So that's the only thing which probably, could be a little bit of a dampener over here. Just some sort of a stock trade.
Okay, so you're looking at mid-tier banks as well as the smaller PSU banks too. Sanjeev Prasad, the other thing to ask you, IT seems to have fallen out of favor, and obviously it has a large global presence. We don't know soft landing, hard landing, growth recession. So, when we're getting all of that kind of clarity from Eurozone as well as America, the question our viewers will want to know is, with the post-correction, would you become a buyer of IT stocks yet, particularly the large cap and the mid-tier ones that had seen such a big run-up and were at one point commanding a higher valuation than the large caps?
The valuations have become reasonable, I would say, but not to the extent that, you would want to, go very aggressive in these names. What you still have to wait and see is how does the whole global slowdown play out? Is this going to be some sort of a soft landing, or, as you said, or it could be, fairly deep recession? Who knows? For the next 6 months, we'll have a better handle on this. It's all linked to, geopolitics, inflation, and the stance taken by the central banks. As of now, the indication seems to be it will be a slowdown, but not a very deep recession. So in that context, things are okay. But it's still not pricing in, I would assume, actually not pricing in some sort of a recession. So I would rather wait and see what happens over here rather than jump in aggressively now. Keep some positions, maybe minor underweight, which is what we have in our recommended large cap portfolio, avoiding the mid cap IT names for now. And just see how things pan out, because if there is deeper and longer recession or a slowdown, in that case, demand will struggle, and more importantly, you will see a lot of pressure on pricing. In a sense, the customers of the IT companies will be in no hurry to close deals. They will take their own sweet time. They will negotiate hard. So all of that will result in a lot of pricing pressure as far as margins are concerned. So apart from the volume slowdown, you also have to keep an eye on profitability in that case.
All right. Just a last word. With valuations being where we are, the way we have outperformed, you think investors should be slightly cautious? You mentioned a few sectors earlier which are trading at very high valuations. So we should be cautious on India in the near term?
I mean, forget about the fact that they've outperformed, underperformed. I mean, the fact of the matter is, you look at absolute valuations for the market, you look at absolute valuation for the stocks on the bottom of basis and take a call. If you find, stocks which look reasonably valued in the context of the growth and risk profile, then you take a call accordingly. So, but on a very top-down basis, it's very hard to make a case, when you're already trading at about 20 times plus on a 1 year forward basis. Interest rates are on the highest side compared to what we have seen over the last 3-4 years, and you have a lot of geopolitical / economic risk out there. So in that context, I think a somewhat cautious stance is warranted. Just looking at the growth and risk profile for the time being.
Sanjeev, on that note, we'll let you go. Thank you so much for making time and speaking with ET Now today.